Hello, everyone. This is Victor Jones. You're listening to TFNN, and of course, as always, every Tuesday at noon, you are now listening to the Options Hour. And for the next hour, myself, I will be taking your calls, and we're going to be going over some very, very interesting topics. Stock repair. If you're listening to the quick chit chat that I had with Tom O'Brien yesterday around 4:30, that's 5:30 Eastern for all of you guys out there on the East Coast, and do the math if you're not. But we were just, quickly talking about what this market has done, and I think today, with the significant move that we're seeing to the downside in the markets today, it's now even more important than it was yesterday. And the conversation was essentially around the move that we've seen from about the 1406 level in the S&P 500. And yesterday, we basically, compared to the volatility we've been seeing over the last couple of weeks, it was a little like watching paint dry yesterday in terms of market action. And now today, you have a significant move to the downside. We're now down 17.5 points in the S&P 500. That's the June S&P 500 index futures contract we're quoting. And so when we have a market that's essentially level shifted from 1410 to 1405 really area down to basically 1350 with where we are now, it's 50 to 60 points, however you want to call it. It's a significant level shift, and I think there may be some of us that may have gotten caught on the high side of some of the stocks, of some of our, potentially going long around those 1400 level. Maybe you have a cost basis that is now above where we currently are sitting in terms of the marketplace, and you want to understand how can you use options to essentially repair, for lack of a better term. How do we repair our position, our stock position, using options? And this is a very, very special hour because we're going to be doing it. We're going to be talking about the positions that you have on. So over the next hour, I want you to call. I want you to tell me about an optionable position that you have in your portfolio right now that you're underwater on. And we want to look at those options. I think as long as it's a liquid security with liquid options, we're going to be able to talk about utilizing these repair strategies. For all of you, as a quick reminder before we get into our market breakdown, just quickly breaking down what the market is today, let me give out the number. And the number is 877-927-6648. All of our domestic partners can reach us again at 877-927-6648. And if you are stationed outside of the United States of America, you can reach us at our international number, 727-445-1044. Let me give that to you again. It's 727-445-1044. So, that being said, let's quickly do a market wrap. All of you guys, I'm imagining potentially we've got some scratch traders out there, I'll call it for lack of a better term. But if you do have a position in there you're underwater on, just give us a call. Let's talk about it. But again, the market today, the S&P 500, 1348 and a quarter. That's down $17.50. We're now sitting below essentially where we would expect to see a little bit of support. The 1360 number, which was basically violated and held yesterday, has now been violated today, and really the next piece of short-term support from a technical perspective is that 1340 level. You see basically a little bit of support there at the 1340 level, but it's definitely not significant. But from a technical perspective, you do see a little bit or that next level of short-term support at that 1340 level. But again, a significant move. We're down about 1.33% on the day in the S&P 500 as compared to the Nasdaq, which is now 2596.5. That's down 40 points. That's 1.5%. So the Nasdaq is unwinding a little bit quicker than the S&P 500. The Dow Jones, again, under that big 13,000 number, again, 12,803, down 156 points. That's about 1.5%. So of the three major indices, the Dow is showing relative strength. The S&P 500 in the middle, and the Nasdaq is relatively weak compared to the rest. The Russell 2000, that's 2,000, the small cap stocks, is 785. And a fifth, that's down $7.60. That's down less than 1%. So small caps relatively strong here today. The dollar index, that's /DX. That is a futures contract trading on the ICE Continental, the ICE exchange, 79.92.5, up 21 cents. That's up 0.25%. The Dow relatively strong today versus a basket of world securities. And versus the euro, we're 1.3014, down 0.0036. That's about a little more than 0.25% down. So really, the dollar is relatively strong versus the euro. It's also relatively strong versus a basket of world of currencies by about the same margin. Gold here, 1601.60, down 37.60, a significant move in gold. And interestingly enough, I think our first call is going to be about gold. But quickly to wrap this up here, down 2.33% here today. GLD, that's 155.5, down 358 if you're tracking that. Crude 96.23, down $1.71. So we're seeing a typical or an interesting correlation here. You're seeing an unwinding in gold, in metals, basically across the board. At the same time, you're seeing an unwinding in equities. You're also seeing a strengthening dollar. That would make sense in terms of the correlation that we're seeing here. But let's go ahead and being that gold is kind of the big mover today in terms of percentage, let's go ahead and take a quick call. We've got Ari in Arcadia as a quick question on GLD. Ari, you are on the air.
So RGLD.
Yes, Ari.
Royal Gold.
Say that again?
RGLD.
Oh, okay. That's RGLD. Sorry, that didn't come through here. We're in Royal Gold. Still similar situation, but today, for everyone out there, for some context, $58.13, down $2.04 today. So they are down basically a little under 3.5%. So a significant move there in Royal Gold. Ari, shoot with your question.
I sold the put on it.
Mm-hmm.
At 55.
Okay.
And I never intended to take possession of the stock.
Mm-hmm.
I could if I want to, but I didn't intend to.
Right.
And so I sold it at roughly 55 cents, and it's roughly $1.50 now, so I got $1 loss. But I'm thinking of, and I'm not in a hurry to do this, but I'm thinking of rolling it down to January 50. Well, I could even do October 52.50.
Mm-hmm.
I take a loss, but I would sell it at a greater amount than my loss, and I would lower the strike price.
Hey, can I ask what month did you sell? What month are you currently in there, Ari?
I'm in June.
You're in June. Okay, so you're in June, 38 days to expiration, plenty of time, so to speak, but I think we're early on here. You sold it at 55 strike with the 2 days. Basically, it's had two pretty poor days, you could say. Today, a pretty strong percentage move, especially relative to gold. You're getting a little bit nervous here at the 55 strike. You're $3 away. And so the question is, you're looking to potentially roll down, and out. In other words, from June to a further expiration, and potentially from the 55 strike to a lower strike. Is that right?
Yes. Does it make sense? I mean, that's what I'm talking to you about.
Yeah. So let's look at a few things. Let's look at expectations. Let's also look at kind of where you sold it, right? Because to know where you sold it is very important, especially when you start talking about rolling, because there's some cases where if people don't take into consideration their actual cost basis or actual credit they took in when they initially established the position, there are some cases where I've seen so many people get into the habit of rolling where they don't realize that even in their maximum case scenario, they're not actually going to make any money. They've essentially locked themselves into a loss. So I think it's important that we start here. The 55 put is trading, let's call it 1.5. That's its mark price, so $1.50. Do you know approximately what the price was? I'm assuming maybe $1 or so higher when you sold it.
Yeah, I don't know exactly, but I would say, let's say around 160. No, well, Yeah, because it fell in, let's say around 160.
Okay. Okay. So assuming, because we've basically level shifted, and if I could just take a guess here, we've level shifted from around $60. We've level shifted from around $60. So I'm guessing maybe it was somewhere around at least a couple of dollars. So you're at least down 50 cents. Let's say you're down at least 50 cents in this position.
I'm $1 down, aren't I?
Okay, so it might have been worth $2.50, and we're now down to $1.50. So we're down $1, and we've got $1.50 credit, but we took in $2.50 to start. So when we're looking at this, obviously we've got to look at what our potential is here, and the potential can really be figured based on what I'll call series implied volatility. Okay, so the series implied volatility, and if you're using ThinkorSwim, it's as easy as looking on your option chain. We basically know what the implied move is from now until that series expiration. So what I mean by that here is the implied move based on volatility is positive or negative. Let's call it $5.80. So if we're currently trading at $58, 68% of the time we would expect to stay within a range of either 580 down or 580 up, which 580 down brings us really close to the 52.5 strike. So I think when we're starting to talk about what strike makes a little bit of sense here, I would say 55 is a little bit aggressive, but 52.5 is really extremely conservative there. 52.5, you're basically getting yourself outside of what that expected move is. But that's just, again, for this expiration. So if you're looking at potentially, so that's how we would look at the current strike, and we would manage those probabilities or assess the probabilities. So we look at the 55 strike that you're currently in, and we say, the probability that it expires out of the money, the 55 strike, is actually still pretty high. It's only 65%. Well, it's 65%. So there's essentially, based on option pricing and based on basically probabilities and theoretics here, there's about a 35% chance that we actually come down and basically touch the 55 strike or expire below it. But there's more that we have to factor into this, because you took in $2.50 credit when you sold the 55. So really your break even here is 52.5. So the probability that we expire out of the money here at 52.5, and again, probabilities are always changing, but if you're just looking at probabilities here, the probability that would expire below 52.5, which is roughly your break even, is 76%. So 3 out of 4 times, given the current pricing and given current volatility, we would expect to expire above 52.5, which is your break even. So I think when you put it in that context, and you start to look at volatility, you start to look at the probabilities here, you start to see a little bit of a different picture. Because when you just look at it over the last 2 days, you see significant movement, right? And you start to say, hey, I don't know if I'm really comfortable with this area. But when you put it in context of, hey, we still have 38 days to go, we're still trading at $58, your real break even is 52.5, it's a little bit different story. And 3 out of 4 times you would expect, given current probabilities, to really expire above that. So the reason I bring that up, Ari, is maybe pulling the trigger now is just a little bit early. And the reason I say that is you still have a pretty good probability of taking in the premium in your strike price. Now, here's something else to think about, is that you said, one of the first things you said was that you don't intend on basically taking delivery of the stock or purchasing the stock.
If it happened, I have the resource in their account, so that's not a problem. But
exactly, and because you've sold the puts outright anyway, unless you're on portfolio margin, they're probably holding the capital outright anyway. So the way that we're factoring this or analyzing that position is one way, and that's to your break even. But you also have to keep in mind that you said at 55 you didn't necessarily want to take ownership of the stock. So anything less than 55, whether you make money or not, because that's ultimately the real test here, because anything above 52.5 you're going to make money, but anything below 55 you're actually going to take ownership of the stock. So if your real intent is to make sure you don't own the stock, well then maybe you want to manage this a little bit differently. But if the idea here is to make sure you're managing your break even, you still have a relatively good probability here, and maybe you start to think about when the probabilities shift a little bit or get closer to that 50% or potentially 60% area, that maybe that's the time to roll. And the other reason I say that is, as you get closer to at the money, your short strike is closer to at the money. Typically, those get you closer to the optimum points to roll to the next month. So I bring that up for a couple of reasons. One, because as you get closer, it'll actually give you a little bit more of an optimum situation to roll. And two, because if you actually analyze this to your break even, you still have about a 3 and 4 shot of collecting or at least coming out better than break even. Does that make sense, Ari?
Yes.
Now, is there any part of that you'd like to dig in on, or that doesn't quite make sense there in terms of how we analyze that to the break even versus the actual short strike?
I didn't.
Pretty straightforward?
Yeah.
Okay.
Can I ask you another question?
Absolutely, Ari.
Yes. I've never got put it, earlier. So it's still not at the strike price. So I'm not worried. It's not in the strike price. They're not going to do anything. But if you go under the strike price, is there a risk that they may put me earlier than the expiration date, or that doesn't happen very much?
That's a good question, and there is a risk. Basically, if somebody owns the call on the call side, right, or excuse me, if somebody owns the put, you've sold the put, somebody owns the put, they have the right to sell it to you. But if there's any extrinsic value, they would be selling the strike. Like, let's say, for instance, you sold me the 55 put. You sold me the right to sell the stock to you at 55. Well, if I were to do that today, one, it's not as economical, because if you add the value of the put, which is 155, to the strike price, you're going to get 56.55, right?
Mm-hmm.
And so 56.55 is ultimately what I'm bringing in for exercising that early, and 56.55 is significantly above the current price in the marketplace, which is 58. So I wouldn't necessarily want to do that early because it's not economical for me on the other side. As you get closer to expiration, that extrinsic value that may exist in the option would erode, and as you get closer and closer to expiration, there may be less incentive for somebody to really wait till expiration. They may put you the stock a little bit early, but in most cases, to you, it's not going to be disadvantageous. To the holder of the put, it'll be a little bit disadvantageous because they're losing on a bit of the extrinsic value. But for you as a risk, yes, there's a risk of getting put early. From a capital perspective, though, it shouldn't disadvantage you in any way monetarily.
Mm-hmm. Yeah. Okay, maybe it could expire, and that'd be great, but if I have to roll it, I may give you another call.
Yeah, absolutely, and I think it really just depends on where Royal Gold goes from here, because we're still sitting, again, keep in mind, we're still sitting here at 58, so 57.5 is really you're at the money. You're still at 55, and the volatility here says that you've still got about a 75, 76% chance of staying above your break even. So I think right now, even though the market over the last 2 days, you're getting closer, and you might be getting a little bit more nervous, let's say, I think you still have, if you're just looking at this from pure probabilities and pure probability of expiring out of the money such that you're above your break even, which I'm just, again, guesstimating at 52.5, and I'm not taking into consideration transaction costs, you still got a pretty good probability. So maybe you'll give it you give it a little bit more time as you approach 55, then you start to think, okay, maybe this is the right time to start rolling, and it will be a little bit more advantageous for you as well because you'll get a bigger credit in the back month as you get closer to at the money.
I appreciate it.
Absolutely. Thanks for the call, Ari.
Take care.
And for everyone, I think that was is such a fantastic call to start the show out with. And I just want to quickly note before we dive into that the market has accelerated its downward move. We're now down to 1346.75. We're down $19, which is about 1.4% on the day. The Nasdaq now down 44.5, which is 1 2/3%, and the Dow 12,789 now down 170, 1 1/3%. So the relative relationships in terms of strength and weakness in the Dow, Nasdaq, and S&P 500 have remained. We've just extended our downside. But again, Ari raised a fantastic question, and that was, hey, I've sold potential puts, and this works right into, I think, the theme of today's hour session, which was, regardless if you have a stock position on and you're long, how do we use options to potentially repair those? But a lot of us, especially if we listen to this show, we've got option positions on, and if we have option positions on, the market has rotated just a little bit. How do we potentially maintain those positions or look to roll? And I think while in this particular instance we didn't look to roll, I think there are many instances out there, and some of you with those very positions on, where that makes a little bit more sense. And the reason, again, in Ari's particular case, there's still a pretty high probability of expiring above break even. Still a decent probability, at 65% chance that he expires above his short strike, which is ultimately what he's trying to manage for. So, but I think there are cases, and you may have them, and you may know them, and you want to talk about rolling up or rolling down, rolling up or rolling out. That's 877-927-6648 if you want to give us a call. Again, 877-927-6648. International callers call 773-244-7150. Let's talk quickly about stock repair. And you can't talk stock repair without really understanding the concept of ratio spreads. And for some of us on the show, when we start to talk about spreads, that's a new concept. So today, we really want to tie in, how to, if we're long a certain underlying security, how to tie in options for the purpose of potentially accelerating where our break-even may be. Because ultimately, how many times have you looked at a chart, and Apple's a terrific example. Apple's a terrific example. I think maybe not a lot of us actually have the capital to be long, several lots of Apple, but it's a good example from a price perspective, because let's look at Apple's performance over the last two expirations. Two expirations. You've seen a move from essentially 520 up to 644, 120 points to the upside. Now, you have to imagine not everyone was buying at 520 and selling at 644. Clearly, a majority or more buyers were available at the 520, more sellers were available at 644, but there definitely is a minority there that has purchased somewhere in the 600 to 640 area. And so what's happened is Apple moved off from 644 down to 560. And what happened? Let's assume you were long in the 620 to 640 area. And this is just a hypothetical. This can happen in any stock with any other prices. But you move down to 560. The market then, after earnings and after the basically analysts and the entire marketplace saw that selling in China and in overseas helped to boost essentially the movement of their iPhone units significantly. We came in significantly above target. You then saw a gap from 560 up to 620. But again, keep in mind, right? That's only 620. There were potential buyers somewhere in between the 620 to 640 range, and that may have not got you to break even. That may got you to break even, but you didn't actually profit off that significant move because you had a cost basis between 600 to 620. So the market moved off to 580 or to 560 from 620. And so unless you test those highs, unless you have a significant trend to the upside where you're making new highs on each successive peak, if you're buying at the highs, or if you and this isn't to say that you meant to do it. Clearly, we don't always mean to buy at highs. But if you're long an underlying security close to where that peak may be, the nervousness here, or some things we start to think about is, hey, if we don't make a new high, I don't get to break even. So in some cases, you start to think to yourself, we could have a small rally, but that's not going to get me to break even. So should I just close out my risk altogether? And so today what we want to talk about are ratio and back spreads in terms of using them to potentially or as stock repair to say, hey, if we rally in this particular example from 560 up to, let's call it 590, I'll actually accelerate my break even, and I'll break even at 590. And hey, if we, in this particular instance, keep in mind that we sold off to 560, and if my break even then right before earnings was 590, we gapped up to 620. Notice I would have made 30 points there, even though we were still potentially below my original cost basis. So today is a very informative session. I would encourage you guys, call in. Let's talk about positions. If you're in a similar example where you're in at a higher price, we've now level shifted down lower in the S&P 500, 50 points. In your particular position, we may be down anywhere from, 5 to 20%. I mean, I was looking earlier at the underlying securities in the S&P 500, which were down more than 20% in just the last 21 bars, which is essentially 21 trading days. It equates to about 1 month. So over the last 1 month in the S&P 500, there are essentially 8 different stocks. Netflix, one of them, ConocoPhillips, SanDisk, Chesapeake, Genworth Financial. There are 8 different stocks which are down even more than 20%. Some of these are very large names with high volume, so you've got to imagine we've got some people out there potentially in these positions, potentially in these particular scenarios. And so with no further ado, let's start to talk through some examples. I think with Netflix being top of the list there, I want to first start the example by Netflix. So let's give a quick history on what's happened in Netflix in terms of price action, and let's jump right into options. Let's jump right into strategy. If you've been watching Netflix over the last 2 expiration cycles, you've seen a move from about 120 to 125, which is a significant recovery to the $60 level it was before. So you've seen almost as much as it recovered. It was a significant and a quick investment vehicle from a 60 to 125. It is now basically given up a significant amount of those gains. We are now from 125 sold off to 72.04 today, trading 72.04 down 141. That's just a little bit under 2%. So today, when we're sitting here at 72.04, there's definitely the potential that, hey, I'm here at 80, I'm long at 80, I'm long at 85, I'm long at 90, and even though relatively speaking, if you're investing for a little bit longer term, that you might be comfortable with being a little bit underwater. But, did you know that you could use options to potentially increase the point at which you're actually at your break even if in fact we do have a bit of a rally? So let's talk through a scenario in Netflix where we can actually use these ratios as a bit of a stock repair. Again, if you have a different example other than Netflix, we're in a similar scenario, I would encourage you, give us a call, 877-927-6648. Now, we're here and we're looking at Netflix. So let's imagine that we went long the stock at 80. Just looking at the chart, it gapped down after earnings to about 90. Let's imagine 10 points lower, we decided to go a little bit, long. So we're long potentially at 80, and that's just for example purposes here. So we're long the stock at 80. So I want to show you currently the market. Let's add a slice here to our ThinkorSwim platform. We're looking at the live price. Here's the live price. And assuming we're long 100 shares, we are now down, in this particular instance, we're down about $785. And our break even, in other words, our point at which we actually, just hit zero, just say, hey, I scratched on this trade, is $8 higher. And so knowing that it's $8 higher just to get to break even is a pretty significant move in a $72 stock. I mean, that's like 12%, essentially a 12% move. So you have to be aware of the amount of time it may potentially take to just get to break even. So then what are your options? No pun intended. Well, some people like to sell calls, which decreases your cost basis. But what can that potentially do? I mean, if I'm long this stock, 100 shares, I could sell a call against my position. And again, for those of you, that may be a new term, that's called a covered call or a buy right. I'm long the stock and I'm short a call against it. Essentially, if I sold, let's say, the 75 call, I would bring in $2 and let's call it 20 cents. I bring in $2.20, and as long as Netflix doesn't rally above 75 from now until May 10th, I'll decrease my cost basis by $2.20. So instead of 80, my new cost basis is $77.80. And so on and so forth. I could continue to do this until the point where either I lower my cost basis, or the market potentially rallies. But here's the issue with using covered calls as a stock repair strategy. It's when you have a cost basis which is above the strike that you're selling, you have there's the potential risk of you getting called away from the stock. So in the scenario I mentioned before, I would have sold the call for $2.20, the 75 call, if Netflix rallied above 75. Before now and expiration, I get called away from the stock. I have to sell my stock at $75. Keep in mind I bought it at $80. Now, I'll get the $2.20, so my effective selling price is $77.20. I'm adding the credit to the strike. Even though my effective selling price is $77.20, that's still a loss from $80. I'm effectively locking myself into loss if the stock does, in fact, rally above my strike price. And I don't think that's a position a lot of us want to be in. So what happens when we use covered calls as stock repair, sometimes what happens is the market rallies, we buy in the call, we roll it out, but still what that's doing is we're experiencing a loss and rolling that call. So effectively you're increasing your cost basis by doing something like that, which is the opposite of what we wanted to do in the first place. Now that we understand some of the risk of using a covered call as a potential stock repair strategy, and again, sometimes it makes sense, sometimes the risk there is a little bit too great, especially if you're deeper and deeper underwater. So what else can you do? Well, you can obviously buy more stock. If I buy more stock at 72, and I buy 100 shares, I've doubled up, so effectively my cost basis would be cut in half. So my cost basis here would be about $76. But that's a whole nother, it's a 100% increase in investment. And some people, for one reason or another, you may not want to increase. Your trading strategy itself may say that, hey, when you get caught in a losing position, we're not going to throw good money at a bad position, so to speak. So you may not be comfortable increasing the investment by 100% to half the cost basis, or increasing it by 50% to bring it down 25%. So in some cases, that's not an option for your trading strategy. And hopefully you guys, as you're listening, you're seeing kind of the progression of thought and the progression of thinking as you think towards using options to supplement a stock strategy. So then what is the next thing that we could potentially do? Well, let's potentially use options. Well, what could we do here? And I want you to notice, as I change the positions here, as I change the theoretical positions that we're on, you're going to notice this line potentially move away from $80. $80 will be fixed at our cost basis, and we're going to see what these different strategies do to our cost basis. So now, one thing we could do is just buy a call. And so the question is, well, I could buy a call, which is significantly less investment. It's not 100% investment. And in buying a call, it could potentially, give me an increased move or increased profitability to the upside. It's going to increase my investment, but not by the same amount as potentially buying the stock. In this case, buying a 72.5 call costs you $600, whereas buying Netflix outright would cost you $7,200. So we're talking about 8% of the capital, approximately 8%. I'm just ballparking that. Approximately 8% of the capital. And so what happens? Well, your break even in this particular case by by buying this potential call at $6. So you're increasing investment by $600, your risk by $600, and you're moving your break even, in this particular case, on expiration, to $79.30. But there's the potential that if you see significant movement today, you would, if the stock moved to $77 today, you would actually be at break even. And that's just because of, the time value or how extrinsic values work in options. So at expiration really is where we're going to concentrate. It's really only improving your cost basis, your break even, by 75 cents. So, okay, that's the 72.5 call. Let's go a strike above. You can see a strike above at 75 is a little bit less investment, right? Now it's only $4.85, so $485. But it really only improves our cost basis by 7 cents to expiration. And then as we go even higher to 77.5 or 80, we essentially see that our break-evens on expiration actually get worse than the $80 investment. Our only potential is to move there quickly before expiration. You can see that it could potentially improve our cost basis by a little bit less than $2.50, but it has to move there quickly. So clearly, in these particular instances where we're buying out of the money calls, it's not as advantageous as we might think. So how do we then, what might we look to? Well, we might look to in-the-money calls, which have a higher delta and act a little bit more like stock. And in doing that, you definitely could do that, and you're essentially getting or doubling down, so to speak, but without using as much capital as it would take to stock. And I think in the initial scenario, in the case that we're looking at ways to improve our cost basis with minimal to no capital outlay or no increased risk. So we've constructed here basically this ratio spread. And the ratio spread has been constructed in June with 38 days to expiration. And let's walk through what we've done. We've bought, so for every 100 shares in this stock repair scenario, you would buy a call. And that call in this particular case, represents another 100 shares, right? So you're representing or you're controlling the same amount of stock with the options that you do with your stock. So if you had 200 shares, then you would buy 2 calls in this scenario. If you had 300, 3 calls, so on and so forth linearly. So if we are at, we've got 100 shares of Netflix, which we've mentioned our cost basis is potentially $80. Well, then how would we construct this ratio spread? Well, we would buy 172.5, and that's just the at-the-money call. One at-the-money call right now is trading right around $6. So what we mentioned we want to do is keep our capital outlay as close to even as possible. So if we notice, we could sell 2 of the 80 calls, which are trading right about $3.15. If we buy one of the 72.5 calls at $6, and we sell 2 of the 80 calls at about $3.15 to $3.12, you'll notice what happens is we'll actually get a credit. So in this particular instance, you're going to get a credit in order to actually do this. That's a 30-cent credit. And in doing so, you're not actually risking any additional capital because you're taking in money. And also what happens is, the long call gets matched up with a short call as a bull call spread, and the additional call that you've sold gets matched up against your stock position as a covered call. So essentially what happens is there's no additional capital outlay. In addition, you've actually brought in money. You've brought in 30 cents to put this position on. And now let's go back to those pretty little pictures that we've talked about. In doing this, look what happens to your break-even at expiration in the front month. It essentially goes from $80 to about a little over $76 for all of our listeners. Let's just make it easy math here. That's $76. Now, keep in mind, what did we say? In order to get to $76 break-even with just stock in this particular instance, we had to increase our investment 100%. right? So if we bought in at, close to 100% anyway, we bought into 100 shares of Netflix at $80, that's $8,000 of capital we just put up. And if we wanted to, again, buy in again at right around $72, that's another $7,200 of capital. We've now got $15,200 of capital that we've committed to this trade just to get down to a break even of $76. Now, in this particular instance, we had a cost basis of 80. Okay, we took in 30 cents. So essentially, inherently, we've taken it down, but because of the construction of our trade, because we've essentially added a bull call spread in there, you can see our break even now goes to right around 76, and we've done that without increasing your capital outlay at all. So I just want everyone, I know that was kind of a long explanation, but in a day like today, where the market is off 1 1/3% in terms of the S&P 500, 1.5% in some of the tech-heavy indices, and when you look at how the market in terms of the S&P 500 has peeled off 50 to 60 points, and you may be in some long positions where you don't necessarily have, you may be a little bit underwater, and you're thinking to yourself, hey, I think the market long-term will rally. Well, hey, that's great. You think the market long-term will rally. Are you going to wait, potentially, are you going to wait until the market rallies to your break-even, or there's the potential sometimes to put on these positions which actually accelerate your profit potential? So keep in mind, again, that, your break-even here is 76, and once we get to 70, if we were to get to 76, you can see you're now break even in that position. And I think that's a very interesting way to look at this, to look at trading, to look at stock trading, to look at how to utilize options for stock trading and potentially repair your equity positions. With that, I think we had a couple of calls there, but you're more than welcome. Now that we've gone over the strategy in its whole, and we've talked really through a very interesting case of no capital outlay and improving our break-even. In this particular instance, it's a very interesting or a pretty advantageous, I think, example, because you essentially with no capital actually bringing in 30 cents, you do the same thing effectively as what it would cost to put up another $7,200. So this is an optimal example. But if you have a position on, and you're thinking to yourself, wow, that sounded very interesting in terms of an equity repair strategy, and maybe you're a little bit underwater, give us a call. Let's talk about that position. As long as there's options on them, there's the potential to repair it in some cases. Again, the number, 877-927-6648. We got about 10 minutes to go, so feel free to give us a call as quickly as possible, so that we can talk about as many of your positions here in the remaining time that we have. But until then, let's go ahead and do another quick market wrap. The S&P 500, 1347, even down 18 3/4 points. That's just shy of 1.4%. The VIX, which we haven't talked about just yet today, is now above that 20 number. That's $20.40, or basically 20.4%, up $1.46, or up 1.46%. In percentage terms or percentage move, that's always an interesting one to quote. It's up a little under 7 3/4%. The NASDAQ 2,592 3/4, down 43 3/4. That's 1 2/3% down. The Dow Jones 12,782, down 178 points. That's a little over 1 1/3%. Again, we're noting the correlation here that the Nasdaq is the weakest of the three indices we've just quoted. The S&P 500, the Dow is basically the strongest. Actually, it's evened out here. The Dow and the S&P 500 percentage-wise are really, really close, so they're about even. The Russell, though, small caps are remaining relatively strong here. 782 down 1080. They're down. Actually, we've accelerated sell-off there. So basically, the S&P 500, the Nasdaq, and the Russell are all selling off in about equivalent percentage terms here today at about 1 1/3%, right around there. The dollar relatively strong here versus a basket of world securities, 79.95.5, up a little under 1/3%. Gold 1602, down 37.10, a big mover today, down 2.25%. And crude oil $96, down 194. And we just want to quickly note what we've been saying and mentioning here in crude for so long, which was that there was a significant amount of risk premium built into the crude markets. We were noting the range-bound movements in crude and saying that, you know what, from a risk-to-reward perspective, given the risk premium that's priced into the market above really the fundamental price, the risk here is a quick correction to the downside, or a basically the market losing that risk premium very quickly. And you've seen over the last basically 4 trading sessions, today and yesterday, relatively similar days. If we still close right around this 96, it'll be a little bit different. But you saw a bit of a hanging man, so to speak, a bit of a hammer hanging man candle there at yesterday's trading session on the futures contract. But you've seen a move from 105 down to 96.08. That's a $9 move to the downside. Basically a little over a 10% move in just a couple of trading sessions, or a little under, I should say, right on an 8% move in just a couple of trading sessions. So a quick unraveling of some of that risk premium, and it made for, if you were potentially selling the premium on the high side, an interesting and quick premium collection. So we do have a quick call here. We're going to take it here. We've got a call from Craig, Minneapolis, who's got a question on Priceline. PCLN is the ticker out there. So Craig, you're on the air.
Yeah, hi. Thanks for taking my call. I really enjoy your show.
Well, thank you, Craig. We appreciate it. Thanks for the call.
So Priceline has earnings tomorrow, and given the learnings of the last few shows, I was just wanting to call in and ask you to take a look at the market maker move on Priceline, and maybe talk a little bit about what a trader might do with an iron condor for these earnings. Okay,
perfect. Thanks for the question, Craig, and I'll try to take us out of the show with that question there. So we're looking right now at the ThinkorSwim application, Priceline with earnings tomorrow, down significantly today, 3.5%. So you're seeing a bit of unraveling there going into earnings. Never a great sign, but $712.23 is where we're trading at currently, down $25. That's just shy of 3.5%. But interestingly enough, we're really at the top end of our range. If you remember, right around when Apple was hitting the 644 levels, now they're correlated, Priceline was hitting 774, and as Apple again rallied, as the market rallied, you saw a lower high made just recently, and now you're seeing a back off of that second high, which is essentially the same price action that you're getting in Apple, that you're getting in the overall markets in general. So the price pattern from a charting perspective or from technical perspective looks very similar to the overall market. Now, as we're heading into earnings, the question that Craig posed was, hey, can we take a quick look at the market maker move? The market maker move is something that's available in the ThinkorSwim application, which essentially backs out or derives the implied move due to upcoming earnings. The market maker move is about $42.24 today. To put that in perspective, on a $730 stock, that's about, what is that, like a 4% move or so? I think that's a 4% move. That. You can check my math, but that's around 4% move. So we're looking right now at Priceline and a 4% move, where does that actually take us? Well, to the upside at $42 when we're trading right around 713, that's about... what's that? 45, 755? 755, yeah. Yep, 755 to the upside. And we've got about 670 to the down. Yeah, 670 to the downside. So 670 would be our downside support, given the market maker move, just obviously tomorrow. And 750 to the upside would be our upside resistance, and we would expect to stay 68% of the time inside of that range. Now, for all the people that don't have the pleasure of seeing this number, or you might be on ThinkorSwim, but maybe you're out of the office. There's a quick way to derive this number. I just want to go ahead and refresh that, Craig, for everyone who might not have been listening for those last couple of shows. The way to do that is to add your at-the-money straddle, which right now is about the 710 strike, which is currently right around 63.30. You want to add your one out-of-the-money strangle, which is about $57 or so. You add those together, you get about $70. You divide by 2, and you get around 35. So I did rough math there, but you can see the expected move is really close if you're doing that thumbnail probability, that old floor calculation. So given that, when you talk about an iron condor, Craig, and to all the listeners, what he's essentially saying is, could I potentially position myself to sell premium above 750 and below 670 so that if the market is priced volatility correctly and we come in with that earnings number and we stay within that range, then obviously I would be able to take some premium out of there. And the question I think to you, Craig, is, do you play the weeklies here? Do you play, 10 days in May, give yourself a little bit of time in case you're wrong for the market to rally or sell off and get in between your strikes? But that's going to depend on how conservative or aggressive you play this. I think the one thing you have to factor in is market movement here. And really I think to just play Priceline earnings without also playing what the potential may be here in the underlying market may be something to really, really rethink. Because if you feel that, hey, we've reached a certain level of support in the S&P 500, that's one thing. But if you feel, hey, we might unravel to X price and continue to sell off, and at the same time there's a potential to potentially miss Priceline earnings, well then you have a 42, you kind of have an increased chance of potentially coming outside of that range. So I think really potentially putting on this iron condor, you got to factor in a couple of things, and that's your expectation on the underlying market along with your expectation potentially in Priceline earnings. But given that, I think we see the strike prices there, and it's just a matter of putting together the short call spread and the short put spread. But I thank you for the call, Craig. It's a great one, and we're going to be looking at Priceline earnings, and hopefully we're going to talk about it next week as well.
Very good. Thanks for your time.
Thanks so much, Craig, and thanks so much, everyone, for listening. I thought today was an excellent show. We want to thank our callers, Greg and Ari, and we'll see you here, same place, same time, next week. Thanks, everyone.